The idea of walking away from a traditional 9-to-5 job with a $500,000 nest egg might seem like an impossible dream to some or a modest starting point to others. But the reality is that with a precise strategic framework, $500,000 can indeed serve as a powerful engine for financial independence. Most people believe they need millions to even consider early retirement, yet by optimizing your withdrawal rates, understanding the nuances of tax-efficient investing, and potentially leveraging geographic arbitrage, that $500,000 figure becomes a sustainable foundation for a life defined by freedom rather than labor. In this video, we are going to break down the exact mathematical reality of living off this amount, moving past the surface-level advice to explore how you can protect your purchasing power against inflation while ensuring your portfolio remains resilient enough to fund your lifestyle for decades to come. Part 1: The Math of the 4% Rule and Cash Flow Reality. Understanding how to survive on a $500,000 portfolio begins with a deep dive into the Trinity study and the safe withdrawal rate, commonly known as the 4% rule. To make this work, you must calculate your annual expenses with extreme precision, because this rule suggests that you can withdraw $20,000 in your first year of retirement, which is 4% of your total nest egg. In subsequent years, you adjust that dollar amount for inflation to maintain your purchasing power. For a beginner, this might sound like a small amount of money, but the mathematical strength of this strategy lies in its historical success rate over 30-year periods, where the portfolio has a high probability of not only surviving, but often growing despite the withdrawals. To take action on this, you must first determine if your current lifestyle can be lean enough to fit within that $20,000 window, or if you need to supplement this income with other minor cash flow streams. The reality of cash flow when dealing with $500,000 is that you are not just looking at a stagnant pile of cash, but rather a living engine that generates returns through dividends and capital gains. If you are an intermediate investor, you know that the sequence of returns risk is your greatest enemy in the early years of escaping work. This means that if the market drops significantly right after you quit your job, withdrawing that 4% becomes much more dangerous for the longevity of your funds. You must understand that cash flow reality often requires having a cash buffer or a high-yield savings account with 1 to 2 years of expenses. This allows you to avoid selling your stocks at a loss during a market downturn, effectively preserving your shares so they can recover when the market eventually swings back upward. For advanced planning, you have to look beyond the static 4% and consider the total return approach versus a dividend-focused approach. While the 4% rule is a guideline, your actual cash flow will feel much more secure if a significant portion of that $20,000 comes from qualified dividends and interest. This reduces the need to constantly sell off principal and helps you manage the psychological stress of seeing your account balance fluctuate. By analyzing your historical spending and matching it against a portfolio that yields a consistent 2 to 3% in dividends, you only need to sell a very small portion of your growth holdings each year. This creates a sustainable loop where your $500,000 stays invested in productive assets while providing you with the liquidity needed to cover your monthly bills without returning to a traditional job. Part 2: Strategic Asset Allocation for Longevity and Growth. Developing a strategic asset allocation for a $500,000 portfolio requires a delicate balance between the need for immediate income and the necessity of long-term capital appreciation to combat inflation. For someone looking to escape the workforce, a common mistake is leaning too heavily into fixed income or high-yield bonds early on, which can lead to a depletion of purchasing power over a 30-year retirement horizon. An effective strategy for longevity often involves a diversified mix of 60 to 70% equities and 30 to 40% fixed income or alternative assets. This equity portion should be broadly diversified across domestic and international markets to capture global growth, while the fixed income portion acts as a stabilizer to reduce overall portfolio volatility and provide a predictable source of funds during market contractions. To ensure growth that outpaces the rising cost of living, intermediate and advanced investors often utilize a core and satellite approach within their equity allocation. The core of your $500,000 should consist of low-cost broad market index funds or exchange-traded funds that track major indices like the S&P 500 or the total stock market. This provides a reliable foundation of historical growth. The satellite portion can then be dedicated to dividend growth stocks or real estate investment trusts, which offer a combination of increasing income streams and potential for price appreciation. By reinvesting dividends during the years you do not need the full 4% withdrawal, you effectively use compounding to expand your principal base, making your financial independence much more resilient against future economic shifts. Actionable allocation also means managing the duration and quality of your fixed income sleeve to protect against interest rate risks. Instead of just holding cash, you might consider a bond ladder or short-term Treasury inflation-protected securities, which are specifically designed to preserve your wealth when consumer prices rise. For a portfolio of this size, it is crucial to rebalance annually or semi-annually back to your target percentages to ensure you are selling high and buying low automatically. This disciplined approach prevents your portfolio from becoming too risky during a bull market or too conservative during a bear market, ensuring that you always have enough growth potential to fund a lifestyle that could last several decades without the need for a paycheck. Part 3. Minimizing the tax bite on your passive income. Minimizing the impact of taxes on your passive income is one of the most effective ways to increase your actual take-home pay without taking on additional investment risk. When you are living off a $500,000 portfolio, every percentage point lost to the Internal Revenue Service is a direct reduction of your lifestyle or the longevity of your funds. To manage this effectively, you must understand the difference between ordinary income and qualified dividends or long-term capital gains. For most people in the United States, if your total taxable income stays below a certain threshold, your long-term capital gains and qualified dividends may be taxed at a 0% rate. This creates a massive opportunity for someone living on $20,000 to $30,000 a year to potentially pay zero federal income tax on their distributions, effectively making their $500,000 go much further than a high earner living in a high tax bracket. Strategic placement of your assets, often called asset location, is another advanced tactic to keep more of your money working for you. You should aim to hold tax-inefficient assets like high-yield corporate bonds or real estate investment trusts inside tax-advantaged accounts like a Roth IRA or a traditional IRA, where the interest can grow without being taxed annually. Meanwhile, your broad market index funds and growth stocks should be held in a standard taxable brokerage account to take advantage of the lower capital gains rates and the ability to use tax loss harvesting. Tax loss harvesting involves selling investments that are at a loss to offset the gains you realized elsewhere in your portfolio, which can reduce your taxable income by up to $3,000 per year against ordinary income, providing a valuable shield for your remaining capital. For those planning to escape work permanently, understanding the mechanics of a Roth conversion ladder or a 72T distribution can provide early access to retirement accounts without the typical 10% penalty. If a portion of your $500,000 is locked in a 401k or a traditional IRA, you can strategically convert small amounts to a Roth IRA during years when your income is low, paying minimal taxes on the conversion, and then accessing those funds tax-free after a 5-year waiting period. By carefully orchestrating which accounts you pull from each year, you can maintain a very low effective tax rate. This requires proactive planning and a clear understanding of the current tax brackets, but the result is a highly optimized cash flow machine that keeps the majority of its earnings in your pocket rather than the government's. Part 4: Geographic Arbitrage and Lifestyle Design. Geographic arbitrage is one of the most powerful catalysts for making a $500,000 portfolio work because it allows you to decouple your cost of living from the currency in which your wealth is denominated. By earning or drawing income in United States dollars while living in a region with a significantly lower cost of goods and services, you effectively multiply the purchasing power of your nest egg without needing to increase your investment returns. For someone with $500,000, a $20,000 annual withdrawal might feel restrictive in a major American city, but in many parts of Southeast Asia, Eastern Europe, or Latin America, that same amount can provide a high quality of life that includes private healthcare, modern housing, and frequent dining out. This strategy turns a modest retirement fund into a substantial wealth engine by simply changing your physical location to a place where the local economy allows your dollars to go 2 or 3 times further. Implementing this lifestyle design requires a shift from a consumer mindset to a strategic curator mindset, where you prioritize experiences and freedom over the accumulation of physical assets in expensive zip codes. To take action, you should begin by researching the cost of living index of potential destinations and comparing them to your current baseline expenses. This is not just about moving to the cheapest possible place, but rather finding the intersection of high-quality infrastructure, safety, and low recurring costs. By reducing your biggest overhead expenses such as rent and property taxes, you lower your safe withdrawal rate requirement, which in turn reduces the pressure on your portfolio during volatile market cycles. This creates a massive margin of safety that ensures your $500,000 can sustain you indefinitely, while you enjoy a lifestyle that would otherwise require millions of dollars in a high cost of living area. Beyond the immediate financial benefits, geographic arbitrage allows for a complete redesign of your daily routine and long-term goals. When you are no longer tethered to a specific high-cost location for work, you can optimize your life for health, hobbies, and personal growth. For intermediate and advanced planners, this often involves spending parts of the year in different locations to take advantage of seasonal climates or tax residencies that further protect your wealth. You must consider the logistical aspects such as digital nomad visas, international health insurance, and the impact of local inflation on your long-term projections. By intentionally designing a life that leverages global economic disparities, you transform your $500,000 from a survival fund into a tool for ultimate global mobility and personal autonomy, effectively escaping the traditional workforce years, or even decades earlier than your peers. Part 5: Risk Mitigation and the Variable Percentage Withdrawal Method. Risk mitigation, when living off a $500,000 portfolio, requires a departure from rigid thinking and the adoption of dynamic withdrawal strategies that respond to market conditions in real time. One of the most effective frameworks for this is the variable percentage withdrawal method, which adjusts your annual distribution based on the actual performance of your investments rather than sticking to a fixed dollar amount adjusted for inflation. By taking a slightly higher percentage during bull markets and systematically scaling back your spending during bear markets, you significantly reduce the probability of portfolio depletion. This flexibility acts as a natural shock absorber for your wealth, allowing you to participate in market upswings while instinctively protecting your principal when the economy faces a downturn, ensuring that you never withdraw too much when your asset prices are depressed. For intermediate and advanced investors, this method also involves establishing a ceiling and a floor for your annual spending to maintain a stable lifestyle while preserving the portfolio. You might decide that your absolute minimum floor is $18,000 a year to cover basic necessities, while your ceiling might be $25,000 during exceptionally good years. This structured variability prevents the psychological stress of total uncertainty while providing a clear mathematical path to long-term sustainability. Implementing this requires a disciplined review of your portfolio value at the beginning of each year and a willingness to adjust your discretionary spending, such as travel or luxury purchases, based on the current health of your accounts. This proactive management style is what separates those who successfully stay retired from those who are forced back into the workforce due to poor timing and inflexible financial habits. In addition to variable withdrawals, comprehensive risk mitigation must address the impact of unexpected large expenses or health emergencies that could derail a smaller nest egg. For someone with $500,000, maintaining a dedicated emergency fund separate from the invested portfolio is non-negotiable to avoid being forced to sell equities at the wrong time. You should also evaluate the role of insurance and high-deductible health plans to cap your maximum out-of-pocket exposure. By combining a flexible withdrawal strategy with a robust cash buffer and proper risk transfer through insurance, you create a fortress around your financial independence. This holistic approach ensures that your escape from work is not a fragile state of being, but a resilient and permanent transition into a life where your money works for you regardless of the noise and volatility in the global markets. Conclusion: making the leap to live off $500,000 is a bold move that requires a perfect blend of mathematical discipline, tax efficiency, and lifestyle flexibility. But as we have explored today, it is entirely within reach for those willing to follow a strategic blueprint. By mastering the nuances of safe withdrawal rates, optimizing your asset allocation for both growth and stability, and leveraging tactics like geographic arbitrage, you can effectively break the chains of the traditional work cycle much sooner than most imagine. Success in this journey is not about having the most money, but about having the best system to protect and grow what you have while minimizing the drains on your capital. If you found this deep dive into financial independence valuable and want to continue mastering the mechanics of wealth, please subscribe to Sam Invests for more data-driven insights. We would love to hear from you in the comments section below, so please leave a comment with the phrase "freedom is the goal" to let us know you are ready to take control of your financial future.